Welcome to today's episode. You've heard about money market funds, we've heard about SACCOs, and we've heard about Treasury Bills. So, where should you invest money as a beginner? Now, all these three options are available. There are many others. We have got bonds, we have got special funds, but the common ones that people normally don't know where to begin with is the difference between these three. So, if you are considering investing in any of this one, but you don't know particularly where to begin, this video is we're going to break down money market funds, bills, and SACCOs, and show you where should you begin. So, by the end of this video, you will understand how money market funds, SACCOs, and treasury bills, each of them, how they work, and what each of them offers, the trade-off that you'll have to make, and which one might be best for you if you're considering to invest. Now, let's dive in right away and start looking at money market funds. So we shall look at what they are. So money market funds are investments that invest in a safe short-term instruments like treasury bills, commercial paper, and bank deposits. Investors normally buy units in a fund. A money market fund is a fund. And what is a fund? A fund is a pool of money where investors put money together, and so that money is invested in a particular asset. For example, and I'll use this to illustrate. Person A has money, they invest in there. Person B, they put money in that fund. Person C in that fund. Person D in that fund. Person E in that fund, and so on and so forth. So that now this becomes a fund. So it's a big fund and can be invested somewhere, either in treasury bills, in commercial paper, or in bank deposits to accrue interest. Once it accrues interest, the interest is paid to individual investors who in turn, of course, at a particular interest. Now, in Kenya, money market funds are regulated by Capital Markets Authority, and the role of this is to ensure transparency, proper governance, and diversified investment rules, as well as protection for you, the investor. Let's look at SACCOs. SACCOs, on the other hand, are member-owned or community-owned. They are cooperatives where members save money together and they can borrow from that pool of funds. You contribute towards your savings on a monthly basis, and the SACCO uses your money to issue loans to other members at affordable interest, normally at a higher interest, so that at the end of the year, profits are shared amongst the members in form of dividends. It's worth to note that in Kenya, SACCOs are regulated by SASRA, SACCO Society Regulatory Authority, a government body that is whose mandate is to oversee and regulate SACCOs. Let's jump to treasury bills. Now, bills are short-term government debt securities. They are normally issued by the Kenyan government. You lend your money to the government for a period of 91 days, 182 days, or 364 days. In return, you receive interest or buy at a discount. They are considered safest because there's an investment with the government. Safest because they are backed by the government, and you know that the government will always be there. Let's look at the benefits of each of them. For money market funds, the one single benefit is liquidity. It allows redemption in a few business days, 24 days to 24 hours, that's 6 hours, 72 hours. Number two, professional money management. We've talked about how money market funds work. So they're handled by experts who diversify the money that is invested in them. Then low volatility, they are better returns than banks. And then finally, transparency. So we've said that money market funds, high liquidity, professional management, low volatility, utility, better returns than as compared to banks, then transparency. SACCOs, on the other hand, one of the key benefits of SACCO is your access to loans, better loans. They are member owned or community owned, meaning that you'll have dividends at the end of the year. Community and trust, because members often share a bond, same employer, same locality, and so this creates a trust amongst the members of that particular SACCO. Then it encourages disciplined savings because you have to save. If you envision taking a loan facility, so you have to save, and this enables you to have a discipline of saving over a period of time. Then possibility of higher returns in good years. In years when many loans perform well, the dividends can be attractive, 10%, 11%, 12%. This year, there are some SACCOs that paid 15, 16, 17%. Benefits of Treasury bills. Number one, safety. Because they are backed by the government, so the risk is minimal. Benefit number two, predictable yield. For bills, you know the rate before you even you get the returns. You know the rate at the time of purchase. Then direct instrument, there's no intermediary, no fund manager. No wonder the rates are normally higher. So when you invest directly and you get the returns directly. Then short maturity, you commit your funds only for a defined short period, 3 months, 6 months, or 1 year. Then finally, transparency. Auction yields are published. This is information in the public domain, so it's well known that these bills are available for purchase. A quick comparison between the three. Of course, this comparison we've already covered them, but we shall look at a feature or a factor. Then we'll look at money market fund, SACCO, and treasury bills. I'll do it very fast because we've looked at them already. Factor number one, liquidity. Money market funds, very liquid. SACCO, lower liquid. Treasury bills, medium liquid. Return yields, as another factor for money market funds, is moderate to high. For SACCOs, is potentially high in good years but variable. Treasury bills, this is fixed. The returns are known, so it's fixed at time of issue and can be competitive in a high rate environment. Let's look at the risks. For money market funds is low. For SACCOs is moderate or high, it depends. Then for bills is very low. Let's look at control or transparency. For money market funds, fund manager makes decision, but these ones are still regulated by Capital Markets Authority. For SACCOs, more members control but have the risk of poor governance. Then for treasury bills, you directly hold the instrument, so it's very transparent. Let's look at loan access or credit access. For money market funds, you can't get a loan. You can't borrow from money market funds. You can borrow from SACCOs and you cannot borrow from treasury bills. Volatility, very low for treasury bills, more volatile for SACCOs, and minimal. Your return is locked in when it comes to treasury bills. Practical observations. SACCOs often require a notice period for withdrawal. Can be 60 days or you have to give a notice. Money market funds will generally give better liquidity. Many allow access within 24 hours, 36 hours, 48, or 72. SACCOs might offer higher returns in some years and will offer some lower returns in other years. And for treasury bills, they will attract investors who want surety and government backing, especially in uncertain market. So, the last question, which one should a beginner choose when investing? For someone who's just starting out their investing and they want safety and want growth, this is a breakdown of how you should be choosing. I compared the three. If you want liquidity, if liquidity is your priority and you want quick access for your money. Money market fund is stronger than SACCOs and is better than locking your money into Treasury bills. So if you want liquidity, go for money market fund. If you anticipate loans and you project that you need a facility for business or for emergency, SACCOs becomes attractive, especially if it's a well-managed one. Go for SACCOs. If you want minimal risks, you want capital preservation, then Treasury bills and money market funds are safest. If you don't want to lose your money, that is, SACCOs can carry risks depending on loan defaults, but rarely. Do your thorough research. If you want stability, you want predictable yield, then Treasury bills will give that certainty. Money market funds will always aim for stability, but yields vary. So SACCOs, dividends always also vary. Finally, if you prefer simplicity and low managing effort, like you don't want to be actively involved, then pick money market funds and pick Treasury bills. They'll be easier. So because SACCOs sometimes require engagement with the cooperative, but that is on a very rare scale. Savvy investors will use a hybrid model. So you keep some of the emergency money or short-term funds in a money market fund. Part of that money put in Treasury bills for long-term government yields and still use some for SACCOs in case your project you'll borrow a loan or you'll borrow a facility. So, in summary, money market funds are powerful for all-rounder. Good liquidity, low risk. They are professionally managed and regulated by Capital Markets Authority. So they give solid returns, 10, 11, 12%. SACCOs are good and because they offer unique advantage of loans, member benefits, and ability to give you dividends, but they come with restrictions and governance risks. Treasury bills, on the other hand, are very safe, ultra safe. They are transparent instruments and they are backed by the government, and they have predictable returns, predictable yields. So if I was advising a beginner, as we conclude, if I was advising a beginner, I would start with money market funds as a foundation for your liquid savings. Then sprinkle some money in Treasury bills for safety and consider a strong, well-regulated SACCO if it offers clear benefits and trustworthy management if you foresee that you need a loan facility. So that is it. I've given that breakdown. There are videos on each of them, how to invest in a money market fund, how to invest in a SACCO, how to invest in a Treasury bill. So that is it for this video. Thank you for watching, and I'll see you in next one. Bye bye for now.